Well, it's a new year, and one of the luxuries of January is that we're allowed, and I would imagine even encouraged a little bit, to just pause a little bit, take stock, and ask whether last year's market narrative still hold firm. Now, 2025 was, by almost any measure, a very good vintage for investors. South African assets surprised to the upside. Global equities continue to defy skeptics, and for many investors, just simply staying invested paid off very handsomely. But markets do have a nasty habit of punishing complacency. So the question for 2026 isn't what worked last year, but what still holds true for now. And to help us unpack that and to kick off what will be a regular monthly conversation on stocks and markets, I'm joined by Wendy Myers, head of PSG Securities. Wendy, it's just great to have you back. And I've got to say, Happy New Year, all the best. And I'm really looking forward to making this a standing date on the Business Talk calendar. So let's just start with a quick look back, shall we? Because I think context matters. If you look at 2025, we saw exceptional returns locally, really solid, maybe somewhat narrower gains offshore. Um, when you look back, what really stood out for you? And did investors who stayed invested genuinely benefit?
Yeah. Well, first of all, Michael, it's lovely to be back. So happy New Year to you. And I think if I reflect on the local markets, it's just so wonderful for South African assets to have performed last year. They really had a standout year. Local equities gaining around 37%, and bonds were up 21% in rand terms, and that's actually even more pronounced that the rand itself strengthened. We saw rand strengthening against the dollar by more than 12%. So, for those investors that have traditionally focused on offshore, that they really lost out if they didn't have exposure to SA assets. And what's wonderful for me is that the performance really was underpinned by improving broad-based domestic conditions. The country's removal from FATF grey list. In addition, we had a sovereign ratings upgrade, a new lower inflation target. We were previously targeting 3.6. Now we're anchoring at 3%. And a notable reduction in load shedding. It all contributes to improved confidence, and it's really just making sure that on the ground we really starting to make traction, and that translates into the JSE's returns. I think it's also important to note that commodity prices, they've had a phenomenal year. Gold, platinum, copper. They've surged, and so that's also provided significant boost to the JSE resource-heavy stocks. I think one of the traders was telling me the other day, if you'd been specific in your stock selection on the JSE and been quite overweight resources, you could have had a 75% return in 2025. I mean, it's just, these numbers are incredible. So it's nice to see South Africa's back on the investment stage again. And I think from an offshore markets perspective, amazingly, global equities also delivered strong gains, particularly in the US. And this is mostly driven largely by this artificial intelligence boom, and any related high technology share related to AI. The weaker dollar, so that you would see the dollar did weaken a lot last year. That also provides a good tailwind for emerging market returns and global assets. This also led to sort of high market concentration and elevated valuations in US tech stocks, which we can unpack. So it obviously raises concerns about the stability of those returns. And obviously we've had geopolitical tensions, the US and the tariff discussions, or tariff wars, however you want to look at it. They've really provided global trade uncertainty throughout the year. And that also was the backdrop for our gold price performing as it is. So, yeah, it's really interesting.
There's so much to unpack in that. But I think what's interesting is that the drivers were very different. South Africa's story more about credibility and recovery, while offshore it was far more, as you say, about concentration and technology. So let's talk about South Africa specifically then, because I think for many investors who may have benefited from that commodity run, you're looking at it now, you're saying, oh, if you're up 80, 90%, should you start looking to take profits? So you've said that this looks constructive for local equities 2026, but not in a kind of reckless way, more from a position of that improved macro stability and the reform narrative. Unpack that for us. What's changed really beneath the surface that gives us this renewed confidence in South Africa?
Yeah, so I think it's important to pause a bit and just unpack the benefits of being removed off the grey list. You know, it's fundamental to so much in supporting South Africa's ongoing sort of returns from a JSE perspective. Look at higher confidence. Delisting off that grey list restores trust. And it signals that our anti-money laundering framework is robust. I mean, that's massive for the country. Being off the grey list also, it's easier transactions. There's no friction. If you think of international movement of money, it's cheaper. There's less documentation because there's no compliance checks. That also leads to reduced costs. So it's cheaper or less expensive to move money. Obviously, we can attract capital. Smoother operations and reduce friction means that the flow of money can move, encouraging direct investment into South Africa. From a global standpoint, just the fact that not only are we off the FATF grey list, we also removed from other countries' high risk list. And that was when we were, from a high risk monitoring perspective, the countries were concerned about dealings with South Africa. That all eases the flow of money and investment from other regions into South Africa. So that's really, I think, amazing. And kudos to those organizations that helped us get off that grey list. A sovereign ratings upgrade, that means credit ratings see reduced risk for us, and signaling improved fiscal health, better economic prospects, stronger institutions. It all leads to lower borrowing costs for the government and just makes SA assets more attractive to foreign investors. And that, again, boosts confidence, and it will lead to further rand strengthening and, again, then lower inflation. So the knock-on is massive for investment and for growth. And our new low inflation target. So interesting enough, foreign investors have actually responded very positively to this change. They see the prospect of low inflation, there's an increased willingness to fund government debt because the government is more in control of inflation. And that with that comes the expectation of capital gains. So yeah, that's very positive for us. And finally, we can talk about improved Eskom performance. It's amazing. Eskom and their instability, it's not just about supplying electricity to businesses. It's all around business confidence. If you look at 2023, when we had all that load shedding, and you track and you actually marry the load shedding graph and how we went from stage 1, 2, 3, 4, I don't know, did we get up to 6? And you plot the rand appreciation on the same graph, they mirror each other because people panic. And they respond to negative news by thinking it's the end of we're going to have a black South Africa. There's no lights that's going to be on. So improved Eskom is absolutely critical for all of us as investors in SA assets.
And they say confidence is the cheapest form of stimulus. So I think everything you've mentioned actually reinforces a renewed confidence in South Africa. And I know initially, come 2018, there was this exuberance, there was a new dawn, and the markets expected a quick step change in South Africa. And I think what we've realized and what the markets certainly come to realize is that the institutions were hollowed out to such an extent that it was going to take time to rebuild that institutional strength. It had been cut down to the bone. We've got to rebuild that institutional muscle. And I think we're now getting to that point and we're starting to reap the benefits of that. So when that credibility improves, the grey list exits, the ratings stabilize, inflation, the expectations anchor. Where does it actually show up first? Is it the rand? Is it bond deals? Is it bank earnings? Or is it just confidence broadly?
Yeah, I think it's confidence broadly. I mean, I've been chatting to a few managers, and they definitely say, overall, you want to be long shares. That's definitely the preferred way to go. We're seeing a bit of bonds aren't going to be delivering the returns they did last year. It's more moderate, I think, from a returns perspective. And the property sector obviously shifts to more stable returns. If you had to look at what industries to watch as an investor, top of mind would be banks, healthcare, retailers, and everyday domestic businesses. They typically stand out. Quality mid-caps, I think, with strong cash flow generation and credible management. That's something also to consider. And then lower rates support credit growth and disposable income and earnings resilience. So all of that will mean, it'll deliver strong returns for those sectors. And I think just finally, Michael, on SA equities, it's important to spend a bit of time on commodity stocks. These typically are very volatile in returns, and they had phenomenal returns last year. So your point about, should investors take profit? I actually think the precious metals, gold, silvers, and base metals like copper, they're going to have another good year this year. They're going to be supported by further rate cuts. And with this move to AI and decarbonization, that's going to continue the demand, and also with global uncertainty. So I think certainly for 2026, we're looking at a continued bull run for gold. Some analysts are expecting it to soar to $5,000 an ounce, some even more. And silver and platinum are also expected. I think in the last week, silver's been running. So so those stocks that have exposure to those commodities really are something to add to your watch list. And, with those stocks and those commodities tend to also be what you favor if there's a sort of concern around stagflation. And that is something that I think all investors should certainly be a watch for, given where we are.
I was very lucky. So I've got a kind of balanced portfolio that is my retirement, very kind of low risk, but fairly aggressively weighted to equities because I've got time. And then I've got a bit of take a bit of a punt money, and I bought into Valterra just over 800 last year, and I'm up 82%. And you look at it and you think, oh, we've had such a good run. But to your point, there's still so much that is supporting the commodity sector at the moment. And we know that operating leverage in these companies, when the commodities run, I mean, if you look at gold, for example, their all-in sustaining costs are between $1,000, $1,400 an ounce. Where is gold heading? It's heading to $5,000 an ounce. You're talking about that's $3,600 an ounce free cash flow that these companies are going to be splitting out and then paying back as special dividends, or you're seeing that capital appreciation in the share price. So it really is a fantastic story, and for the fiscus as well. It'll be very interesting to see how this translates into the budget next month, because it means increased royalties, increased taxes. And it's also where discipline matters most. So also not chasing last year's winners, but just understanding why you're in the portfolio in the first place. So let's just lift our eyes for a little bit offshore, because I think many South Africans still feel underinvested globally, even after a very strong 3-year run in US markets. And given what we saw last year, as we sit here at the start of 2026, what's the realistic outlook for investors looking offshore?
Yeah, so I mean, amazing enough, the S&P delivered 17%, 18% in 2025. I didn't think many people thought it would get to that level, because it's the third year in a row that the US stocks have delivered. What we are also seeing, we're looking at Europe. I think Europe also is going to deliver some good returns this year. I think broadly, analysts remain very positive on global equities for the 2026 year. Some are forecasting double-digit gains. At this point, expectations are quite diverse, because I think it really depends what you're invested in. So from a analyst perspective, anything between 3.7 and 18% is what's expected. So, I mean, very different, right? But that's because the bulls all point to an AI sort of driven super cycle. And that's what is fueling, obviously, record capex expenditure and rapid earnings expansion. If you look at 2025, the 7 stocks that represented just over half of the S&P 500's gains, it's your typical NVIDIA, Alphabet, Microsoft, even JP Morgan, Palantir is a new performer, and Broadcom. All these stocks have an exposure to AI in some way or another. They're all aligning to investing in AI and making sure that they have efficiencies through investing in that capability. We're also expecting the Fed to lower interest rates further this year, and that's going to support higher stock prices. What's interesting is that in November, the Dow started to outpace the NASDAQ. Now, you know that obviously those stocks that I just mentioned, The Nasdaq actually is where those returns are reflected, but the Dow is those sort of left behind companies is now starting to almost catch up. So it'll be interesting to see if the Dow actually delivers more so than the Nasdaq this year. I think that's what I'm personally looking out for.
Broadening out effectively and getting away from some of that concentration that we saw in the US markets over the last few years. So
yes,
if we
very much so.
if we pull all of this together, local and offshore equities and income, how does an investor benefit from all of this? What does a sensible portfolio construction look like going into the new year?
Yeah, well, Michael, I do a lot of reading at this time of year to get a sense of what we can expect. And I read a fascinating BlackRock article, and it was entitled "The Odds Are Changing," and that 2026 is a market for investors, not gamblers. And their view is that last year was certainly in the US was dominated by a small number of companies delivering returns. And analysts now see 2026 as a year that will provide the best opportunity, believe it or not, since the global financial crisis, to actually play both sides of the distribution. In other words, to own high quality income and durable and also get durable growth and being paid for your risk. But you need to be selective on stocks. So I think that's what's important there, is that what that article is saying is effectively an investor's market, not a gambler's market. So really, I think with global policy being very supportive, we acknowledge that overseas there's fiscal deficits, in the US in particular, but they've got the liquidity to sustain that. And the Fed will continue moving the interest rates down. And that can all provide a good cushion against sort of downside recession. So I think my view, in summary, as always, Michael, stay invested, reinvest your returns so that income and time can do the heavy lifting for you. The key is, I think, to go into this new cycle owning those stocks that generate good, strong cash flow. So from a dividend perspective, you want that income. Obviously, there's going to be bumps in the road when we have, Trump saying something or whatever it is that drives volatility. But markets wobble. That's the markets. But your income will continue to deliver for you. And as you continue to reinvest that money, it will obviously work to bring your portfolio towards its long-term path, which is to get good growth. So I think the one thing I would love to leave investors with for 2026 is to make sure they have exposure to SA equities and offshore. At PSG, we recommend 60% local, 40% offshore. That might be too aggressive for some, but the point is stay invested, make sure you get your dividends, reinvest your dividends, and enjoy your portfolio returns.
And ignore a lot of the noise, because I think what you've just discussed shows that often the headlines, the weekly headlines we might be reading out of Davos and Greenland, and the Trump effect is very much to saber rattle and then come back to something more sensible. I think that's one thing we've seen. So if you've been trading on the noise, you probably would have lost a lot of money rather than being sensible, as you said, and staying invested. And I love that line you quoted from BlackRock, that this market looks like a market for investors and not gamblers. So that's one I'm going to take into the new year. And I really look forward in the new year to be then touching base with you monthly, saying, well, which are those stocks that are really standing out, and giving more great examples and insights to listeners here on Business Talk. Wendy Myers, thanks so much, head of PSG Securities. It's going to be a great year. Let's hope it's a super profitable year for all of us. Thanks for your time.
Thank you, Michael.